Welcome to the Rose Show podcast.
Welcome to Unlimited Macro and Markets Outlook 2023 with Bob Elliott. I'm Rosanna, your host, and I'm here with Bob Elliott, co-founder, CEO, and CIO of Unlimited Funds, bringing the indexing revolution to alternative investments. So can't wait to learn more about that a little later in the show. This is good. Yeah, this is going to be educational, but most of all, lots of fun. So just a quick disclaimer, please do not construe this as investment or financial advice. So thank you once again, Bob, for joining us today. And please tell us about yourself, your background, your business.
Oh yeah, sure. My background is 20 years as a systematic investor, primarily in the macro market space. I was at Bridgewater Associates for almost 15 years, where I was a senior executive and built trading strategies across all the major asset classes, many of which were in the Pure Alpha Fund, the flagship Pure Alpha Fund. I left, I guess it was almost 5 years ago. I wanted to get back to something a little more entrepreneurial. Spent some time actually running a $125 million venture fund, which systematically identified high potential early stage consumer opportunities. You can think about using big data to run systematic venture, which was very interesting. But over time, my experience on sort of the public side and the private side of the 2 and 20 world, I increasingly recognize that 2 and 20 managers are pretty good at generating high quality returns, and they're also pretty good at charging high fees, leaving investors not much better off than they would be otherwise. And so that got me to thinking about whether there was a way to use technology to bring the concepts of sort of low cost indexing into, that totally changed stock and bond investing, bring that into the world of 2 and 20 to sort of look over the shoulder of what these 2 and 20 managers are doing, sort of see what they're doing in close to real time, and then take that understanding, replicate it in long and short liquid securities positions that can be packaged as ETFs. And so that's the basic idea. And because we're using technology instead of analysts, we can charge, a quarter of the cost that investors might face. And because it's in an ETF versus an LP structure, depending on the details of it, it's about half the taxes. And so the basic idea is 2 and 20 index returns that are a quarter of the cost and half the taxes. And our first product is HFND, which is an ETF that launched 3 months ago. It was the fastest growing independent, actively managed ETF launch of 2022, with over $50 million in it in the first 3 months. And it replicates the gross of fees returns of the hedge fund industry, using that technology that I described. And over time, we're going to issue a whole bunch of other ones. So, if HFND is right for you, definitely check it out. And, I think it offers a good opportunity to access a diversified set of hedge fund strategies, in a very investor-friendly ETF wrapper. And I'll pause there. That's me. I also
awesome. I love it.
Guy on Twitter too. That's
Thank you so much. That was great. We're going to get more into the different alternative asset classes and alternative investing, because I think that concept, unfortunately, isn't as common and isn't much discussed nowadays. And it hasn't for the past, 15 years, we've been in this 60-40 portfolio mentality.
Exactly. Yep.
So we need to discuss this. And I, being an entrepreneur for 25 years, and I guess that dates me, but that's okay. And being an investor for just as long, I've been always looking at alternative investments and creative investments and all that. So I find your fund fascinating. I love your website too. I mean, the democratization of macro and alpha and reducing fees. This is the 21st century. I mean, this is the way things should be. And it's been very slow moving to have a disruption in this industry. So fascinating stuff. Love it all. Definitely been to your website. Great website as well. So let's dive into the macro and let's get started with this graduate level class of macro. I'd like to start with the Fed and inflation. I think that's a good starting point. I love your tweets. Your tweets are so informative. They're usually long threads. And I want to start with this notion that the market seems to think that CPI comes down in 2023 to a rate of about 2.5 by mid-year. We all know it's very sticky with the wages and services especially, and elevated inflation should be maintained. And this will take time to work through. And I know one of your tweets said, we likely will have more inflation and more tightening before we get through this period. Could you discuss all that, please?
Yeah, for sure. I mean, the focus, I feel like, everyone has had a microscope on the inflationary dynamics over the course of the last, 18 months or so, 24 months. I think it's important to contextualize what we're seeing today when it comes to inflation and the overall cyclical dynamic is we're seeing a typical inflationary cycle, business cycle, which was exacerbated by supply shocks related to COVID, and exacerbated by incredibly expansionary or easy monetary and fiscal policy at the beginning. And so, the way that dynamic typically works is you have relatively tight labor markets. You have an elevated economy, which we certainly have. You have relatively tight labor markets. Those relatively tight labor markets lead to relatively strong wage growth, and that relatively strong wage growth helps finance what did we talked about this, maintains spending. You said maintain a few weeks ago, and I love that way of describing it because elevated wages leads to the maintaining spending, which feeds back into the economy and allows for continuation of relatively strong growth until the point in which the Fed tightens enough so that you get the breaking of that cycle. And so what we're seeing in the inflation side of that is you could almost draw a straight line on wage growth and say that's sort of our baseline inflation that's going on, right? Let's call it the wage growth, the nominal wage growth relative to productivity. Productivity is close to zero. We won't get into all the details of that. The gist is basically productivity is zero. Wage growth is 5 to 6%. Those two things have been pretty consistent in the last couple of years, and productivity has been low for very long, for 15 years or something like that. So we have this basic dynamic where the underlying mismatch between nominal incomes and productive growth of the economy on an incremental basis is about 5 to 6% today. And then we have overlapping it, you could almost think about it like an extra wave overlapping that straight line, where we've had a supply shock, which caused a lot of elevated prices, particularly in traded goods and things like autos. Those issues are being resolved. And so that supply shock kept inflation even more elevated than wages would have suggested in the back half of 21 and early 22. And now what we're seeing is the transition to those dynamics being resolved, which is creating a disinflationary impulse. As they get resolved, so you're seeing falling used car prices and some odds and ends in furniture prices and stuff like that, some odds and ends in the traded goods market. And so that's going to create a headline number that over the course of the next 6 months, let's say, is going to look a little lower than that wage number. But because that spending power exists, because the economy remains relatively strong, that baseline inflation of 5 to 6% is not going away. And so what we're probably going to see is something which, in the same way we had a transitory, although it took 2 years, goods positive, tradable goods positive inflation impulse, we're likely to have a transitory disinflationary impulse occur in inflation, which will probably come to a head in the second half of 2023 once you have a situation where that sort of works its way through the system and we get back to sort of that baseline comparison between nominal wage growth and productive capacity in the economy. And that's where we get back to that sort of 5 to 6% still too elevated relative to what the Fed is, the Fed's desired rate of inflation.
Exactly. I know you had a tweet exactly regarding that, which I found very interesting. And first of all, you mentioned how the deceleration pattern that's been emerging the past 2 months was mostly due to the medical, which was odd, and that was high. And then you also mentioned the disinflationary forces of core goods may have bottomed. And I guess that's what you're referring to as middle of next year, maybe it could possibly reverse. Do you think that's possible so that inflation can reaccelerate?
Exactly. I think folks often forget when they're thinking about inflation that what we've had, for instance, in the last couple of months of the year, is we've had used auto prices fall about as fast as they've ever fallen. And we've seen oil prices fall pretty significantly. And those have created disinflationary impulses, right? Disinflation or negative inflation contributions to the overall inflation picture. But in order for that level or that magnitude of disinflation to persist, you actually have to have the prices of those things keep dropping at the same rate. And that is unlikely to occur. Even right now, we've seen, if you look at the Manheim index, you start to see some indications that the declines in used car prices are likely to decline less fast than they have been declining. That's very important, because if something declines less fast than it has been before, the disinflationary impulse that it's brought to the overall CPI starts to moderate in comparison to some of those other more inflationary dynamics, like more wage-driven, services, ex-housing was, I think, what Chairman Powell calls it. Those things will continue to persist in terms of their inflationary impulse at the time when you've got these other things moderating, which will bring the overall number up. And so, it's hard to very precisely pencil out all these nuances and exactly the day in which we'll get back. We'll have this sort of path of transitory disinflation or transitory goods disinflation. But we're probably looking at a period here for the next 3 to 6 months where inflation isn't really the problem, where you might get a bit of a Fed pause or a slowing in the pace of their hikes, plus that moderating inflation, plus a little stimulus from oil prices following, will actually be a net positive for the economy, which means that we'll get stronger growth, which is what we've been seeing in the last couple of weeks of the fourth quarter, which will then further tighten labor markets, which will extend the pressure on the Fed to continue to tighten. I know that's a complicated set of things to think about how they're all interacting with each other, but I think what we're going to see is kind of a period of relative calm. Looks like good growth. It looks almost Goldilocks, almost soft landing-ish, where we have this period of, and I say almost because it's not durably Goldilocks or soft landing. It's a transitory Goldilocks or soft landing moment where growth is strong, inflation is moderating, but that will just sow the seeds of higher inflation and tighter required policy later if it happens today.
Makes sense. I think it's important that we discuss it, and I appreciate you going in detail about that, because we should all be aware of that. We're not out of the woods. We shouldn't be making a victory lap and saying, hey, it's coming down and we're out of the woods. I think that there's some serious issues going into next year, as you discussed. And I think entrenchment is a big issue as well. And I think that we have inflation entrenched in many areas of the business at all levels. So that needs, please go into that.
I mean, you're an entrepreneur. So am I. I see all these contracts, and a year ago, all these contracts had 2 or 3% subsequent year hikes embedded in these contracts, right? I'm sure you had to deal with these things before, and now every contract I get, it's 10%, it's 15%. Now that's an anecdotal story, but it kind of gives you a sense as to that's exactly the sort of thing that creates that durability, the durability of inflation, that persistence of inflation, that, it takes time for that to emerge and build out over time.
I agree completely. I've been discussing this for a while as well. As a business owner, I'm a CEO. I've been in business a long time, and we've been through the various economic cycles. We were in 2008 with actually the same business, and we've been through it. We know how it works. But yeah, I've been seeing an elevation in prices still. Things are changing. There are not only higher prices, but there's new fees. And we have like with the employment, we have an IAS surcharge that occurs with employment. It has to do with employee benefits, how New York State, we're in New York State, depleted their funds for the enhanced benefits during COVID. So they had to borrow from the Fed. So now we have this new fee that's added on. And that's just one of them. There's plenty of them. So, and that has to work through the system. So that's going to take time, may take a couple years. We don't know how long we're going to have these additional fees. But there's also, I wonder if it's just the vendors capitalizing sometimes on this entrenchment. Can they just keep raising prices? I'm still getting letters in the mail for increases in some of my cost of goods sold, 5 to 10%. So, yeah, it's real. It's an issue. It's embedded at all levels. It's going to take time to work through the system. So, so I see it on the forefront like you as an entrepreneur. So there's no Goldilocks here. The labor market definitely holds the key to inflation. Like you discussed earlier, the nominal wages have grown significantly, and we have increased tightness in the labor market, which is putting pressure on the consumer prices. And I love how you make the point that even though the general definition of a recession is 2 negative GDP quarters back to back, how can we be? We have such a tight labor market. And so, I'd love to go into that a little bit. Services spending is mostly a function of employment and wages. And if you could discuss that whole dynamic, and then regarding the GDP and the growth, I appreciate that.
Yeah, for sure. I mean, I think one of the things that I think is really important to recognize for those folks who have been in markets and been thinking about sort of the macroeconomic cycle, but have a lens that is really the last, say, 10 or even 20 years, is that typically when you talk about employment indicators, eyes glaze over and, you get snarky comments in your tweets about how it's a lagging indicator, things like that, because everyone's like, oh, everything else is a leading indicator. And I think it's important to recognize we are not that dynamic that all of us have become accustomed to is very much driven by credit cycles. When you have a credit cycle, the first thing that moves, the Fed tightens, the credit declines, that leads to reduced spending, and that really leads to reduced labor markets. And so labor market dynamics are the last thing to move rather than a coincident or important driver of the forward-looking dynamic. We have something very different today. There was no credit boom driving the elevated economy. We had a fiscal transfer boom. We had an easy monetary policy boom, neither of which were a credit boom. And so instead, what those things have done is they've created a wealth of savings, or a moderate amount of savings for many income cohorts. Plus, as we've talked about, the wages and the wage growth is pretty good. And the thing that's different in an income-driven inflationary cycle is that the employment market. Employment really holds the key to maintaining the spending. And so what would typically be the last thing you'd really look at becomes much more important in this cycle, because in order for this cycle to break, what we need to see that labor market start to weaken, because then that will help weaken the wages, which will then help weaken the spending, which will then help weaken the inflation, which will then, will help weaken the spending, which will help weaken the earnings, which will then flow back through to the labor market. And so that's why, I'm sure some of you folks who are on here either enjoy or are annoyed by my weekly squinting at the initial claims data. But that's because it is the critical linchpin to what's going on in terms of whether this cycle will continue on an expansionary direction or not. And I'd say when you look at that dynamic today, and you look at employment dynamics in general through a cycle, like it is slow moving. Just remember, employment is slow moving. And so even very front end sectors of the economy, the most sensitive sectors of the economy to interest rates, like the housing market, well, let's look at construction employment. Let's look at how, real estate related employment, still growing, right? Still growing about as well as it has this cycle, a little bit less than 12 months ago, but like it's growing, it's fine. And that gives you an indication. Typically it takes 12 to 18 months for that dynamic to eventually flow through and start to slow. And that's because it takes a long time for these labor markets to slow down. And so when we look at where we're at right now, we still are at secularly tight labor markets, strong wage growth. Maybe it will start slowing down, but even if it started slowing down today, it's going to take 12 to 18 months before we get to an employment situation that looks a lot closer to a recession than what we have, today.
Yes, and you make a valuable point that even though we have an inverted yield curve, it doesn't mean the recession's coming in the next month or two. And some people tend to think it's going to be here right away. And it can be, I think it's 9 to 28 months for a recession to occur after the yield curve, correct?
Yeah, exactly. And if you're running money, the difference between 9 months and 28 months is a huge difference, right? I mean, that's the difference, between that'll make or break you, right? And so that's why those sorts of indicators, they're like they have bad ratios. They're bad at trading asset markets on a risk return basis because they're so inconsistent like that.
I love when you say we receive our weekly reminder of the labor market tightness. And that is correct.
I'm gonna get known for my weekly reminder, and then I get the good thing is I get the weekly the same people giving me the weekly snarky comments on my weekly reminder as well. So it's a nice it's a nice cycle.
It's fun. And we got to make this fun. We're going through it. We can't change the events. However, we can change our reaction to them. So might as well have a joke here and there regarding this tight labor market. It's not only an imbalance of supply and demand, but what we've noticed as an employer is there's a mismatch of expectations on both sides. So we've noticed a lot of issues going on in the labor market. And regarding the data, there has been a lot of talk on Twitter and other places I've read regarding inconsistencies in the data. Well, we know about the Philly Fed numbers being off, and then the NFP, the establishment versus the household surveys, how the multiple job holders are getting counted since they're appearing on more than one payroll. They're getting counted more than once, and they're maybe inflating those numbers. Do you find any of that relevant, or is that just noise to you?
Well, I think this is a good it's a good example of dealing with the uncertainties of macroeconomic data. And I've spent essentially a career looking at not just the data itself, but understanding and appreciating what we call sort of the goodness of the data. And I think there's many times in which what you get is you get a conflicting set of reads about what's going on for all sorts of good reasons, in the sense of like there's sampling error, there's issues with methodologies, there's all sorts of things like that. And I think the most important thing to do in those circumstances is to triangulate. And I think, you can't just look at one data source, because what you can always find one data source almost always find, except maybe in the extreme booms in the depths of a depression, you can basically always find something that will point to a positive or a negative. And that's, so that's fine. There's people out there in the market who point to things that are positive somewhat exclusively, and people who point to things that are negative somewhat exclusively. And my recommendation on these sorts of cases is to triangulate across different pieces of information in order to get a holistic understanding. So as an example, very, very simple thing with this employment, this is a great week because this is like the employment data week, right? Everyone loves the employment data week. We get all sorts of different pieces of information ranging from various ISM employment surveys all the way to, the household survey, to the establishment survey, to, initial claims. And so there's a whole wide series of information there, some of which is realer, is what I like to describe it as. So like often you'll find initial claims is realer in the sense of like there are actually people submitting actual applications of, claims for unemployment that get added up by county and state and to the country as a whole. So that's a bit realer than some of the survey information. But really there's all this different information. And so you're best off when you look at it to just sort of add it all up and kind of average the whole thing to say, where when I look at all of that different data, where does it net me out at? And that's where I think in many ways, when I look at all those different pieces of information, you see something that looks like, the labor market is secularly tight in a level sense and is growing modestly, right? Probably not as strong as what the payrolls are suggesting, but not as weak as the household survey is suggesting. And so you're getting a moderate growth rate at a tight level in a labor market, which is, it's very important to recognize, is secularly growing very, very slowly. Like some would argue, it's a bit ambiguous, but some would argue that that labor force growth in the U.S. is basically zero. Okay, well, if it's basically zero, you don't need a whole heck of a lot of employment growth to keep the markets tight. And so I think that that's sort of the thing you have to do is you sort of have to look at all those different pieces. I would be wary of the person cherry picking one particular data source or another particular data source and hawking their argument. And I would be extra wary of someone who says X, Y, and Z data source leads relative to A, B, and C data source. It's not true. None of the data sources lead the other data sources. I could bore you to tears on those points. It's not how it works. And so I would just say, look at all of it together in a well triangulated way to come up with that holistic understanding of what's going on.
Exactly. Agree completely. You should always look at all the data points. When you see that middle point where everything seems to balance out is sort of where you probably have your answer in that little range in there. And agree not to take just one survey or one data. I also like to look at the beverage curve and the fill rate. And we discussed this via tweet. And, it's always important to look at more data points. And so those are also interesting. There's just so many different data that we could look at regarding employment. But yes, absolutely. I wonder if, 2022, everyone had their eyes on the CPI and a PCE. It seems like maybe 23, like you said, the first half of the year, inflation may take a back seat. And now we're all going to be focused on these labor data, which is why this week is such a hot happening week here. And we're looking at JOLTS, we want to look at NFPs, and we want to look at maybe earnings as well. So that's what we're going to go into next is earnings. What are your thoughts on earnings and this whole talk of the earnings recession this year? Do you think there's more compression challenges upcoming with earnings? What are your thoughts on that?
Well, from an earnings perspective, we've got kind of an interesting moment here where we've got some moderation in inflation, but an increase in real demand, particularly by households, and we've seen that in the last couple of PCE reports. Relatively stable, moderate nominal demand, and increasing real demand because you've got a circumstance where as prices fall, it allows for stronger, overall real demand for households. And so that's sort of the dynamic that's going on. On the other side of the picture, you have, essentially those things. Like when you think about earnings for companies, earnings are a nominal concept, very important to recognize, nominal concept, not a real concept. So like real GDP growth is not the thing that drives earnings. Nominal growth drives earnings. And so when you see that dynamic, I think it's very important to recognize that we're probably having a bit of a moderation in nominal growth. It's unlikely that it would persist quite as elevated as it did in the first half of 22, given the inflation and the savings of households meant they were spending a lot more. They were spending a lot more than what their income growth was. And so instead, now what you see sort of on a forward-looking basis is moderate, pretty good, but not fantastic, moderate earnings growth. I'd say moderate nominal sales growth, which will lead to probably moderate earnings growth, maybe a bit weaker, but kind of in that ballpark of things, because wages are starting to shift to where you're starting to get a little bit of real wage growth, and the inverse or the corollary to starting to get a little real wage growth is actually to get some margin compression. And so we're going to see something that looks boring as far as earnings, somewhere between modestly okay and kind of putzing along, at a zero, kind of in that range. That's not a particularly exciting. It's hard, it's not an earnings recession, it's not an earnings boom. It's kind of a putzing for the next 6 months, let's say. And then, I think there's like on the margin a few other incremental points which do sort of flow through, which to the extent that the domestic earnings are a bit softer, you get a circumstance where the weakening dollar, which really doesn't have much of an effect actually on the economy, on the domestic U.S. economy, because imported goods are not particularly significant in the U.S. and whatever, and they're also priced in dollars, so it doesn't really matter. But you do get a benefit for those companies from the falling dollar. It's about 0.5% for every 1% move in DXY, and so this DXY weakening that we've seen is going to give a little bit of a jolt to earnings in the first, reported earnings in the first quarter, probably, relative to that sort of broader dynamic that I'm describing.
Agree. Our business is international, so I've noticed a huge reduction in our international business when the dollar was near its high. And this past year, I mean, we had probably about 35% of our business is international. And this past year, I just did a report. I think we were like at 5% or something, which was so strange. And that those foreign business held us up pretty well in 2008. With that phenomenon. So it's just interesting to see from the business side how things change quite rapidly. So hopefully this falling dollar does help, and it should, I agree. Now, inflation holds up revenues as well. I mean, I think I've noticed in our business, revenues are being held up more so by inflation than higher output or volume. So my thinking is if inflation's maintained at this level, I mean, let's just put out a number, 4 to 6% or something in that range, higher than the 2.5 that they're trying to say we're going to be at by mid next year. At the same time, like you said, I think earnings are going to be that blah range, that just like a nothing, like they're just going to be in there, not necessarily a recession. Or not anything that great. So we just could be right there because inflation's holding up those revenues. I mean, the cost of goods and the margins are definitely compressed, and I'm noticing that. But yeah, hopefully it will be in that range, which is still far better off than having a recession.
Yeah, and I think that's kind of the surprise that could happen in the in the equity market, you could have a bit of a surprise to the upside in terms of people. There's a cohort of people, many of whom we read every day and interact with every day, who are basically like, recession is here. It's not true. And so that cohort of people repricing away from short equity positions could very easily give a little bit of benefit to the equity market, and frankly detriment to the bond market in the first half of the year, relative to sort of a bit of the gloom that has permeated the equity market. When I look at what hedge funds are doing, which is essentially what we do in HFND, is look at what the hedge funds are doing and then try to replicate that. Like, we see, hedge funds are still maintaining relatively low risk, but it is interesting to see that they're starting to dip their toe in the water, is what I'd say, in terms of taking on a touch more equity risk, probably, which is aligned with this idea of, we're going to be kind of okay for a period of time, relative to being in a recession dynamic.
Yes, thank you. I love the point that we live in a nominal world, and I think that's if anything, the takeaway here is the data you receive, the revenues, the earning, everything's in nominal terms. It's not like people go around saying, oh, this is real and this is nominal. So everything is in a nominal numbers. You made a point regarding, when we talk about different asset classes, we have, commodities, cash, and we talk about the private sector as well, and private credit. And so that's also another asset class. You mentioned how some data that you came up with regarding venture capital funds, and you said how 22 seemed like the biggest theme was outsized losses in the public and maybe crypto markets, and that 23 could be the biggest theme, could be the recognition of losses in the private markets. Very interesting. Could you please go into that?
Yeah, I mean, I think it's important. The private markets. I'm sure there's some number of folks around here who are investors in private market funds and in venture funds, et cetera. I've seen both sides. I've traded in the public side. I've traded in I've invested tens of millions of dollars in the private side as well. I'll preface this by saying I come from a macro perspective. That's my way of thinking. Like, a lot of people will tell you a lot of things on the private side about how they add value and how they do, they can pick companies and they get in on good deals and all this stuff, and how they can, make the companies better. And the frank reality is that private market investors, by and large, in the last 15 years, have not shown themselves to be particularly all that good, or they haven't shown themselves to be much better in terms of outperformance than holding a portfolio or basket of publicly traded companies that have similar attributes. And so I think that's particularly true in the venture space, which is what I show in my in one of my recent posts, where, like, if you just take unprofitable tech companies, they experience about the same rise as what venture indexes, how they performed. And so, if we look at that, we see something that looks a lot like, those companies in the publicly traded markets are down 80%. I think in a lot of ways, the marks on those companies in the private world were delayed because there's a bunch of fundraising in 21. Typically, you raise, between 12 and 24 months of burn rate capital. When 22 hit, a lot of them tried to cut their burn rate, and we've obviously seen layoffs associated with that. Although they don't really matter for the macroeconomy, they matter for the venture, the New York and San Francisco tech areas. And so they've been able to extend their runway a little bit, but that's coming to a close. Many of those companies are starting to basically get to their last dollar, and we'll be faced with either one of two things: raising capital at very significantly depressed valuations, which there's some decent companies out there that make sense to continue to fund. The reality is the vast majority of them were built on, expectations of zero interest rates and monetary easing forever. And so those companies and those business models, they're just not going to be successful in a world where, money isn't free and plentiful. And so what we're likely to see here is that a lot of those companies are just going to run out of money, and that's going to be it. And they'll close up their shop, and that'll be the end of their business. And at that point, both of those things, either the raising of money at depressed valuations or the closing down of those companies, to be basically no longer ongoing concerns. Those two things are likely to have. Those two things are the things that's necessary for the venture investors, the venture funds, to remark their assets, because up until those points, you could just pretend like everything's okay and the companies are going to get out of it. But once a company fails, or once they raise at a lower valuation, you can't really lie about it to your investors. And so that's where we're going to see a pretty significant fall. And there's $1.5 trillion, give or take, of dollars in venture businesses today, in venture funds today, from investors. We'll probably see that fall 70 or 80% in valuation. That's not that much different than what we saw in the bust in 2000. That's $1 trillion of losses, mostly held by unlevered folks, pension funds, endowments, and high net worth individuals. But $1 trillion of losses is certainly nothing to sneeze at, particularly for people who think that it's going to come.
It's absolutely significant. I mean, we have crowding out effects, and one sector affects the other, and everything's interrelated. To me, when I think of this period we're in, I mean, the free money, excessive risk taking due to that, significant rise in central banks' balance sheets is what's contributed to our situation. And the venture market, I mean, the startups and all those businesses, the private sector, is inevitably affected as the reality sets in of where we're at now, and that free money is no longer available. And you're going to have to be more careful with investments, and that's why I always stress fundamentals matter. It's a different time period. Is this really a strange time period? No, I actually think that 2020 was more of an anomaly and a different time period. And we're getting back to reality, but this will take time, like we've said. And some people, I think maybe I don't know if you referenced it, but it's almost like we're in an everything bubble. This time period's like a mix of many different bear market cycles. I like the analogy to the 40s, post World War II. Then there's the 70s, the 2000. We can look at 2008. We can look at all these different factors in time, the different time periods, and being you taught a macro class, so in order to learn, we have to study different time periods. No time periods completely repeat, but it's important to compare, to understand. So your goal has been, for the past 20 years, I know, producing alpha, and that's your key. So how do you take all these time periods, all this stuff together, and how do you focus on generating alpha?
Yeah, I think it's a great question. I think when you think about many people, when they think about generating alpha, they focus on, how do I become a great trader to be able to call the next big change in Fed policy, or the next big cycle in equities or things like that. And I think what I've seen over time is that that can generate reasonable returns at a point in time, but it's also very susceptible to luck. And many people get those sorts of trades right, because they got lucky rather than because they have skill. I think the key thing to creating what I'd call is durable alpha, so alpha that you can rely on over time, is by creating edge or identifying edge. And edge is not big edge. There's no durable big edge that's out in the world. And the reason why there's no durable big edge out in the world is because if there was durable big edge, the biggest, most sophisticated asset managers in the world would go out there and arb it away. And so instead, what kind of edge exists is the type of edge that exists in the world that's durable edge. I should say, I had a conversation with Meb Faber recently. It's in the podcast I did with him. And we were sort of joking, like, people talk about how they have 5 ratios or something, 5.0 Sharpe ratios. And it's basically like, that doesn't exist. 5.0 Sharpe ratios don't exist in the world. Anyone who tells you they exist is either fooling you or fooling themselves, or trying to fool you or fool themselves. And so instead, the thing that can be durable is to try and get a little bit of edge. Right? If you get a little bit of edge, if you are able to, on the margin, predict, the earnings cycle a little bit better than the market, or Fed monetary policy a little, or monetary policy a little bit better than the market, then what you do is you create all these little edges. And the way that you generate durable alpha is by taking all of these little edges that you have and taking all of those things and putting them together in a diversified portfolio, where you're not over relying on getting one bet right or another bet right. Because the very best managers, that's the example, the very best managers in the world get any one macroeconomic bet right in a month, 55-45 or 60-40, right? So if you think that you can do better than 55-45, either you have to believe that you're one of the most talented and successful asset managers that have ever lived, or you're wrong. Like that's the reality of the circumstance. And so it's important to then say, if that is the reality, how do I put on a bunch of bets that are slightly in my favor all the time, in a way that creates a diversified portfolio, in a way that, I'm flipping the coin that's slightly weighted in my favor a bunch of times, so that I get a little bit better on the upside than I do on the downside, in order to get that edge, in order to get that durable alpha through time. And that's really what I've found, what I see as that's the thing that creates alpha, or that's the way in which you can create durable alpha, is by doing that thing, not taking big yo's on particular outcomes.
I love that. I love that word, durable alpha. That is key, because it, in different markets and different cycles, some traders, I guess, or investors, whichever word you want to use, can have alpha, but it's that durable alpha, and that's key. And Sharpe ratio of 5. Wow. I mean, that's actually comedic. It's funny. I mean, 1 to 2, I think is great, but especially with volatility, having the standard deviation, there's no way you could have 5. That's just funny that you guys joked about it. I guess that's actually, I find that funny as well. But risk adjusted returns are key, and with newer investors, 2020 created bad habits, and we all know that. We lost money. It was opportunity cost. If we didn't invest in stocks, or in the highest growth stocks, it's like we were losing money because we just kept making money. So not being invested was actually the greatest loss. And nowadays we're back to reality, and it's you got to think, how much am I going to lose first and foremost before I make the investment? Which is why it's so important to assess your risk in order to create durable alpha. And I love that, Bob. Remember that word, durable alpha. That's what I'm going to keep saying from now on. The only certainty is uncertainty, especially nowadays. I want to, before we go into the different asset classes and the alternate assets, I like to just touch upon housing. Everyone talks about the housing market, and there's a lot of talk about a crash coming, and some say it's just a much needed cooling. Of course, we know it's like the slowest moving of all, and it's a very slow process going on. And, the 2008, they try to compare it to that. I mean, that was a banking financial crisis that, we have much stricter lending standards now, and foreclosure levels are actually below average right now. But what are your thoughts? I know the NAHB actually, there's been the smallest drop this past month, in the past 6 months, for Builder Confidence Index. And I know you referenced that as well. I saw that. And they said in the report, we may be nearing a bottom of the cycle for builder sentiment. With all those numbers and all those factors, what are your thoughts on the housing market and its effects, and what may transpire there?
Well, I think the thing that we're seeing in housing is what a typical we're seeing a typical frozen market dynamic where where buyers have become less interested in buying. Certainly, the marginal buyers that existed prior to the Fed hikes have become less interested in buying because if you have to borrow money and pay for a mortgage, the price of the house or the marginal, the monthly cost has gone up too much for you. And the sellers aren't that interested in selling because, they have the opportunity to just use the house. So, you don't have to sell your house. I mean, most people don't have to sell their house. So obviously, always a modest amount of transactional volume that occurs. But basically, you've got, when it comes to the existing housing stock, a frozen market. A lot less activity, less buyers, less sellers, prices starting to modestly fall. And what we're probably going to see over time is that those sort of market dynamics over the course of years, eventually a more fair market price gets established because there's some people who have to sell their houses, or there's new builds that essentially have to get sold, and there's some people who, for whatever reason, are buying houses, and slowly but surely there will be a move towards an a finding of the true value of housing, and in that context, over time, um, the new supply of housing will moderate because it'll become less and less attractive to build new houses and sell them as the price goes down. But that whole cycle, well, I should say one more thing. It's important to recognize that where that settles is very different than the crazy charts that you see around mortgage payments, and which give the suggestion that prices are going to fall 50% because the marginal 90-10 LTV borrower has to pay twice as much in a mortgage payment. That's not how this settles. What happens is the people who are the marginal buyers and sellers at the peak start to change a lot, and so the people who end up becoming the marginal buyers at the bottom are people with much stronger balance sheets, much more cash-oriented investors. Maybe not literally cash buyers, but instead of taking a 90-10 LTV loan, they're going to take a 50 LTV loan or something like that to buy a house. And so where it settles is not where that levered borrower would buy. It's where that better balance sheet buyer comes into the market and buys. And so we're probably going to see something that's not down 50%. No way it's going to be down 50%. Maybe it's down 25%, something like that. And over time, you're going to see a situation where building is going to reduce because selling houses at down 25% is less good than selling houses at the peak. But that whole thing is so slow. it is unbelievably slow how long that whole dynamic takes. I had a tweet a while ago which talked about when the timing of the NAHB, and when in the previous cycle, the housing bust cycle, when you finally saw meaningful declines in construction, employment, etc. And those sorts of things take something, in that cycle, to be clear, in that cycle, which was the greatest housing bust in 100 years, it took like 2 years plus for that all to flow through. 3 years, almost 3 years, for all that to flow through from the peak to actually starting to get very weak employment in the construction sector. And so 2 years in the construction sector, 3 years in the overall economy. And so what you see, and this cycle is not anywhere near as bad as that, because we don't have the leverage, we don't have, the foreclosures, we don't have the forced selling, we don't have any of that. And so housing is going to be a drag, but it's going to be a boring drag through time, and not sufficient on its own to end an economic expansion that's so driven by very strong nominal income growth.
A lot of boring things going on, it seems like. Thank you so much for your input on that. Very important. And I'm going to look for that tweet. But yeah, great stuff. With all this boring stuff going on, let's talk about the market and the market's current reaction. You had tweeted, equities still look overvalued. Do you believe that the market's pricing in that inflation has peaked and then they're smooth sailing ahead? And what are your thoughts on, you reference 6 months from now as a real critical junction in time, and it's up to the Fed on which direction they want to go. And it seems they may go even tighter. Rates will stay higher for much longer. I know we're not in the business of predicting, but just from your experience and looking at all the macro data, what potential SPX levels or market levels do you think are possible when you say next leg lower?
Yeah, I think this is the thing that is hard for people, I think, to fully visualize, because often what you're trying to see is, well, I think there's going to be, is the stock market going to go up or down? And it's like, well, it's complicated. Like, there are a lot of expectations for an immediate recession that are unlikely to be fulfilled. That could tactically be a bullish pressure, probably is tactically a bit of a bullish pressure on the stock market, as recession fears don't necessarily materialize as quickly as people expect. It's probably not good for all asset prices, but it's probably good for stocks relative to bonds during that period. But the question becomes, if we believe that the labor market is relatively tight, and we believe that the economy has relatively strong momentum because there is relatively good income growth driven by those tight labor markets, which is leading to relatively good nominal and real spending, then the question is, what has to happen to break that? And the thing that has to happen is you have to get monetary policy, which is tighter than currently priced, in order to start to further drive asset prices down, in order to start affecting people's and businesses' spending patterns. And so that's the dynamic that we're talking about, which is that's the dynamic when I say stock market is I don't know, overvalued in a longer term sense, where you have this dynamic where you're going to need lower asset prices to break this economic cycle, and therefore your equities are going to be an important component of that. And so in some ways it's like we'll have an illusionary soft landing Goldilocks type dynamic, which will then only necessitate tighter monetary policy, which then in the future will create an even worse dynamic for asset prices in order to break the economic cycle. And so that's when I say that, where could stocks land? Your guess is as good as mine, to say 15 times at 200 earnings for the S&P 500, 3,000. That would be kind of a normal cyclical bottom. That wouldn't. I think the idea of saying, if for whatever reason I'm wrong and this whole cycle moves faster and we start to see stocks in that sort of range, the idea of starting to leg into stocks in that range seems reasonable to me. Nothing is precise in that way, but you're you're probably going to need to see something in that order of magnitude in order to start to get folks to folks and companies, individuals and companies, to start meaningfully changing their behaviors.
Exactly. Thank you. That makes sense. I mean, yeah, it seems that, the Fed has no choice but to continue the rate hikes. I mean, we need to reduce balance sheets and stop deficit spending. I mean, there's a lot of issues going on, and it seems that this tightening should continue. And I like the point you made about the last leg of tightening will probably create the final leg down in financial assets, with a great buying opportunity. So, as I always say, challenges are here, but there will be opportunities upcoming, as there always are through historical time periods. We've seen that. Now, I believe there are opportunities currently, and 2023 is most likely going to be an alternative asset class year with real diversification across different asset classes. So I'd like to get into these alternative investments, as your firm is focused on. What are your thoughts on the various asset classes? You made an excellent point regarding bonds. I'd like you to mention that as well. I agree with you on that. Let's talk commodities and cash and all that, please.
Yeah, I think the first thing, whenever you're thinking about investing, you have this trade-off between cash and assets, and really cash and risk taking. So let's start with cash and risk taking. I think it's pretty important to recognize that I could say all the things that I just said in the course of the first part of this conversation, and there still is a lot of uncertainty. Like this cycle, it's the first inflationary cycle that we've seen in 40, 50 years. There's a lot of uncertainty about how tightly or how rates and QT will affect the economy. There's a lot of uncertainty there. There's reasons to think it could be more influential. There's reasons to think it could be less influential, slower or faster. So there's a lot of uncertainty there. And so when I think about the overall picture, the idea between taking risk and holding cash, this would be a period where I would be thinking very much around having relatively modest leverage or risk taking in my asset portfolio, regardless of what my views are. And it's interesting if you look at hedge funds and you look at where they're positioned today, they're basically at 25-year lows in terms of risk taking, other than extreme crisis periods, because there's so much uncertainty in the market. And that's a really important thing. It's just acknowledge the uncertainty. And in that context, this is not the time to be a hero. This is a time to make a set of modest bets that you think have a bit of positive expected value, relative to what's out, what's priced in, and hope and put enough of those on the table and have them be not 100% correlated to each other so that things work out. This is not the time to be a hero. You might be great as a function of luck, or you might get ruined because of it. So then under the hood, as you go under the hood there, you think about asset classes as they're positioned today. In general, since it doesn't look like we're at the end of the Fed tightening cycle yet, given the macroeconomic dynamics, it's still not a great time to hold assets relative to cash. And so in general, I would be thinking about having, low beta relative to historic positions. And then under that, when you think about particular assets, you want to think about what does the asset what is the asset pricing in relative to what is likely to transpire. In that context, when I scan across the world of assets, I look at something, let's start with something like commodities, or break-even inflation. I see commodities, I see basically inflation being priced into the market extraordinarily lowly, where basically everyone expects inflation to go to 2%, back to 2%, and people expect commodity inflation to be very modest. It could be that way, but it certainly seems like things are skewed the dynamics are likely skewed to the upside rather than the downside on inflation, because if we were to get to something that would create a big disinflationary impulse, the Fed could ease meaningfully and maintain inflation. So that's on the inflation side of things. When you look at bond, and commodities and break-even inflation, when you look at bonds more holistically, I see something that looks like, the expectations of Fed tightening or easing in the second half of the year seem like not that high a probability given the macroeconomic dynamics we're seeing. That would align to be short bonds. And then stocks, we've talked a little bit about stocks. I think we're probably going to see a bit of a transitory Goldilocks type dynamic on the margin that would make me more bullish stocks than other, more bullish stocks certainly relative to bonds in this dynamic, though recognizing that at some point we're going to get to a point where the economy starts to slow down and an earnings decline. The tightness of monetary policy will create an economic slowdown and cause stocks to decline. And so that's very tactical in terms of where I'd be positioning stocks. I think I've covered it.
That's perfect. Thank you so much. And like how you said, we discussed the yield curve, saying how the inverted yield curve, recession can be that wide window of 9 months to 28 months, which is significant. So let's say we're even out, 2 years. I mean, there's a lot that can happen between now and then. And, with these equities, like you mentioned, and this tightening coming in, and which is inevitable. No time to be a hero. Agree on that. And the point about bonds, it's best. I think you had mentioned it. Many people are buying bonds to get ahead of the coming recession. But actually, if you look historically, the start of the Fed easing is a better time to start buying bonds. So that would be like later on. So I like that idea of shorting bonds, and and the equities is no Goldilocks. That's a good one there. Could you tell us more about the services you offer at Unlimited? I went through your website and I found it fascinating how it's an alternative asset index return, and they can be just decomposed into drivers. And you mentioned the structural, cyclical, and tactical. Could you please go over those for us?
Yeah, what we're trying to do at Unlimited is we're trying to do is look over the shoulder of sophisticated asset managers and understand how they're managing money, how they're positioned at any point in time. And there's a lot of information. If you look at their returns and you compare them to which they report, with relatively high frequency, and you compare that to what sort of assets or positions they could plausibly have on at any point in time, you can solve for what portfolio best describes the returns that we're seeing, and because positions are path dependent, there's actually information value in looking at the returns through time to the portfolios that describe those returns through time, which helps inform you about what portfolio best describes the returns today. And so the way that we do that is we look at it from a couple of different lenses as we're looking at that. If you think about any alpha strategy, it typically has those sorts of components. There are more structural exposures, there are more cyclical exposures, there are more tactical exposures that managers are putting on at any point in time. And so those are a couple of the lenses that we triangulate in order to build our overall view of what positions they have on. I think the most important thing, if we go back to that idea of how do you get durable alpha, how do you get a bit positioned marginally in your favor across a bunch of different asset classes across time. I think what we're trying to do here is if you look through time in all the different ways, hedge funds, there's a whole variety of ways in which they generate alpha over time, and they spend billions and billions of dollars figuring that out and have tens of thousands of analysts doing it. I think what you see over time is that those funds themselves are good. They're actually quite good at generating alpha durably over time, using all the different techniques that they have. The problem is that they're also very expensive. And so if what we can do is we can see what they're doing and replicate it, even though that replication will be imperfect, but we can do it at a much lower cost because we use technology instead of hiring a bunch of analysts. What we could do is we can actually we can cut the cost and basically create a lot of fee alpha that exists and allow the everyday investor to gain access to that type of positioning through time, but at a much lower fee structure, so that they get the investor gets the benefit of the alpha and not the manager, the way it works today.
Love that. That's definitely what we all love to hear. Cost reduction is key, and reducing fees to the end user is key in an environment where it seems like we have so many fees rising and new fees. So that's wonderful. Thank you so much. Now, I just want to touch upon commodities. I know cash, it's not a crime to hold cash. And I know you and I both seem to tweet about, cash and having cash. And, I always say cash may have inflation, but, most asset classes seem to have negative expected returns. So, having cash is safe. But regarding commodities, how are you and your firm looking at, let's say, the metals versus the, agriculture or oil, or any ones in particular that you tend to be more bullish on? And do you use futures or ETFs or the miners and all that, please?
Well, I think structurally for most portfolios, most people, most investors are radically underweight commodities. And the reason why they're radically underweight commodities is because A, they don't hold any, right? And B, their liabilities, like what they're going to use to spend the money on, is subject to inflationary pressures. And so, commodities don't perfectly capture inflationary pressures, but there's certainly an aspect of inflationary pressures which are driven by commodity prices, and cyclically commodity prices tend to rise when inflationary pressures rise. And so frankly, it's crazy that most investors don't hold commodities from a strategic perspective, because they help diversify returns and they help protect you against the rising cost of your liabilities. And so that's the biggest thing I'd say is, like, look, in some ways you could try and, get into all the details from an everyday investor perspective. You can try and get into all the details and try and think about gold relative to oil, relative to metals, relative to other things. The reality is you could just buy a diversified commodity basket with 10 or 15% of your portfolio, and you will be so much better off than you are today. And I think it's particularly important today because what we have is a pricing of those commodities, which is basically pricing in secularly, a return to stability at 2%, which might happen, but it also very well might not happen. And we might have a circumstance where we have, a long period of elevated inflation and commodity prices. And so, now is a great time to do that diversification because you're not paying that much for it, because the prices of those commodities are actually quite depressed relative to what could plausibly occur through time. Many of the commodities are back below where they were before the Ukraine war, and so that is, started the Ukraine war, and so that is, that I think that's a great buying opportunity. Under the hood, I think the vast majority of investors could just buy something like BCI, which is just a sensibly weighted, diversified basket of commodities, and frankly not worry too much about it. There's things under the hood that you could think about. I actually don't know that much about, I haven't spent much time in my life thinking about commodity producers versus the physical commodities themselves, or futures. I've mostly traded in futures and physical commodities. And so there could be opportunities in commodity producers, relative to the exposure of the commodities themselves. But it's not an area that I have particular focus on or any particular opinions on. The biggest thing is buy some commodities, get that up to 15% of your portfolio, and you'll be in a lot better shape in the event inflation comes in higher than what people expect.
Excellent. Excellent point. The risks of inflation are clearly skewed to the upside. So inflation protection, like the BCIs, like you said, or just gold and commodities, it seems to be on the cheap side, especially that it's back to the beginning of the war. I'm also in the actual physical and futures myself. I didn't. I don't have any exposure to the producers, any of that. I mean, there's always expenses attached to the production side of it. So I rather go with the pure commodity itself. And although it's never purely pure, but as much as possible. So agree on all that. I wouldn't want to disagree with you on macro though. So not a surprise there. Bob, is there anything I missed that you'd like to share with us or discuss today? I think we went through a lot of different topics, but is there anything I missed that you'd like to mention?
No. I mean, it was quite a whirlwind tour, right? I mean, I think there's so much going on. It's such an exciting time to get back into it. And I think it's going to be. I think part of the, I guess, a bit of a go to the whole thing is recognize that we're going to be learning a lot about how this cycle is going to play out. We have a lot of uncertainty right now. We get incremental new information, and we'll learn a lot about how the cycle is likely to play out over time, over the course of the next 3 and 6 months. My guess is that that cone of uncertainty will decline or narrow in the course of that next 3 or 6 months. And there's nothing wrong with waiting. There's nothing wrong if you don't have a confident view. There's nothing wrong with just withholding cash. I say just holding cash, and then I caught myself, because holding cash is not necessarily a problem if you're not confident in where your view is going to be, particularly today, where you have a circumstance where you're actually earning like a decent yield on cash, right? A little different, before COVID or before this tightening cycle. And so, the most important thing, the thing that really causes problems for investors is in challenging market environments trying to take on too much risk, trying to time things, etc. No one has ever been destroyed by experiencing a moderate amount of positive return. And so, holding cash may not make you popular at cocktail parties, but it can very much protect your wealth over time, particularly in challenging market environments. And so, don't just get focused on which assets to go long and short. I think it's, think about how much risk you're taking on and how confident you are that it makes sense to take on that risk.
I love that. Thank you. We don't need popularity contests at cocktail parties. I'm proud to say I have a significant position in cash. T-bills are, it all depends on everyone's strategies, but T-bills short term, 4 weeks out, is just another idea out there. I agree, 3 to 6 months. But yeah, exciting times, history in the making. Grab your popcorn. Definitely interesting on the macro side. I think we're all going to learn a lot more about macroeconomics through this whole time period. Thank you so much, Bob, for taking your time today from generating durable alpha to speak with us and educate us on macro factors. We touched upon a little bit of everything, like a potpourri of macro and different topics. But we truly appreciate you sharing your time with us.
Yeah, thank you so much for having me on. It's been great getting to know you via Twitter, and it's nice to finally talk in person, so to speak.
Exactly, I agree.
So really do appreciate you inviting me to join you on this conversation. And if obviously folks who are interested in keeping up with at least what I'm thinking, what you see on Twitter is in many ways looking over my shoulder and seeing what I'm thinking about. There's sort of no more, no less than that. So definitely feel free to follow me and engage here on Twitter. And if you're interested in learning more about Unlimited or HFND, the ETF, definitely check out our website. There's a link to our blog, and you can direct yourself to information about HFND in my bio here on Twitter. So definitely check that out.
And that's www.unlimitedfunds.com. I'm actually have the website open right now. It's a cool website. And congrats on the fund and all the upcoming funds that you'll be launching. We're very excited to speak more about that. And I look forward to meeting up with you again, maybe in the next few months to give us an update on the macro front once again during these exciting times. So thank you. And we'll talk again soon and see you all on Twitter, and wishing you all durable alpha.
Thank you so much for having me. It's great to talk to you. See you all later.
Bye-bye. See you. Bye-bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.